Talking about the macro data, urban food prices led retail inflation to a 10-month high, while industrial production grew at the fastest pace in 9 months. Does this indicate a revival from the 6-year low of GDP growth? Let's break it down with Aditi Nayar. She's the principal economist at ICRA. Aditi, thanks very much for taking out the time on both these variables. What were your initial thoughts?
Thank you. Good morning. Certainly the IIP data did come in higher than expected, and that had happened in the previous month as well. So that's a little bit of an interesting sign. However, I must say that after getting a higher than expected initial print for the last month, we ended up getting a substantial downward correction yesterday for the month of June. And on top of that, we now got a 4% plus growth in the month of July. So on the face of it, while it seems to be a pretty substantial recovery, and it was also broad-based, 5 of the 6 use-based categories did show a better performance in July as compared to June. But I think we do need to, treat this data with a lot of caution, because some of the high-frequency indicators that we have for the month of August are actually quite worrying. And that basically, what I'm referring to is the fact that Coal India's production has actually contracted by around 10% in August as compared to around 5% in July. Auto production, we've already seen the numbers. We've got an 18% contraction in the month of August as far as the production is concerned. And not really clear on the visibility in terms of when these deep production cuts are going to end. We are getting pretty close to the festive season. So, if you're going to continue to see these production cuts, then that's going to be a worry. Of course, the base is going to start to be supportive for auto numbers from about September, October onwards. And the third cause of concern is that even electricity generation has contracted in August by a very mild extent. But having said that, I mean, we're really not used to seeing contractions on the whole as far as electricity generation is concerned. So I would actually look more at the initial data that we have for August and not get too enthused by the IIP data for July in terms of really looking at how to forecast Q2 GDP and GVA growth. So just going back a little bit, the biggest factor that led our forecast for GDP growth being so far away from the 5% number which came out for Q1 was manufacturing. And I think even now, looking at the various pieces that we have, it is difficult to conclude that we're going to get a major revival in manufacturing GPA growth in Q2, other than just simply the base effect becoming supportive.
Right. Right. Let's also talk a little bit about the inflation numbers, the CPI data that came out. Food inflation remains, somewhat benign. But going forward, what is your expectation of the trajectory of inflation? Do you see it going above 4%, particularly on the back of normalization of food inflation? And therefore, in light of that, what would the projections be in terms of what the RBI could do in the form of rate cuts?
So as of now, food inflation is evolving along our expected trajectory. It is rising partly because of seasonal factors like the flooding-related increase in vegetable prices. And we do think that the overall scenario as far as the late surge in monsoon and the pickup in Kharif yields are actually only going to be optical for the near term in terms of being beneficial. Broadly, don't expect the late surge in monsoon and the related flooding to support the Kharif yields, but what it is likely to do is to be beneficial for the Rabi crop going forward. So as of now, I would expect that food inflation would continue to harden in the near term, and that is something that would put some amount of upward pressure on the headline inflation number. On the other hand, as far as the core inflation is concerned, it came down only by 2 basis points in August. And really, we do think that the composition of the core CPI, which is heavily dominated by services, is something that would remain quite sticky even during the slowdown. So So to some extent, I would expect that CPI inflation will continue to rise slowly but steadily over the next few months, and possibly, come near of 4% or maybe around late Q3 or Q4. But on an average, we do expect CPI inflation for FY20 to remain at around 3.5%. Given the fact that there is no clear visibility on an upturn as far as the growth slowdown is concerned, I do think that we will get another rate cut in the October LPC review, and possibly 25 basis points is what we could factor in at this point in time.